If you've been watching the markets lately, you've probably noticed a lot more ups and downs than usual. The first quarter of 2026 has been marked by significant volatility, and understandably, many investors are asking the same question: what's going on, and what should I be doing about it? Today, I want to walk you through what's driving this volatility, and more importantly, how to think about your investments during times like these. The biggest driver right now is geopolitical uncertainty, specifically on the ongoing war involving Iran. This conflict has had a ripple effect across global markets. One of the most important areas being impacted is energy. Iran sits near the Strait of Hormuz, one of the most critical shipping routes in the world. Roughly 20% of all global oil supplies move through this region. So any disruption immediately impacts oil prices. And that's exactly what we've seen. Oil prices have surged, in some cases pushing above $100 per barrel, and that has a direct impact on inflation. When energy prices rise, transportation costs increase, goods become more expensive, and inflation pressures build. That creates a challenge for the Federal Reserve because higher inflation often means interest rates staying higher for longer, and markets don't like uncertainty. We've already seen multiple weeks of stock market declines, increased volatility, and a spike in what's known as the fear index, or otherwise known as the VIX, signaling heightened investor anxiety. This is a classic risk-off environment where investors pull back from riskier assets and look for safety. What makes this situation especially challenging is that geopolitical events don't come with a timeline. We don't know how long the conflict will last, whether it will escalate, or how it will ultimately impact the global economy, and markets crave certainty. Historically, wars and geopolitical shocks tend to create short-term volatility because they disrupt supply chains, energy markets, and investor confidence. But it's important to remember, this is not new. We've seen this before. The Gulf War, the Iraq War, the Russia-Ukraine conflict. Each time, markets react quickly and emotionally. But over time, markets adjust. So the big question is, what should you do? First, it's important not to overreact to short-term volatility. Market swings like this can feel uncomfortable, but they are a normal part of investing, especially during periods of uncertainty. Second, this is where diversification becomes critical. A well-diversified portfolio is designed for moments like this, because while some areas of the markets may struggle, others may hold steady, and some may even benefit. For an example, energy stocks may rise with oil prices. Defensive sectors may provide stability. Bonds may play a role depending on interest rate expectation. It's important to know that diversification doesn't eliminate volatility, but it does help manage it. And third, stay patient. Trying to time the market during uncertain periods is extremely difficult. In fact, some of the best market days historically come very close to the worst days. If you miss those rebounds, it can significantly impact long-term returns. At the end of the day, volatility is the price we pay for long-term growth. Periods like this can feel unsettling, but they also remind us why we build disciplined long-term strategies in the first place. The key takeaways are simple: stay diversified, stay patient, and stay focused on your long-term goals. Because while the headlines may change, the principles of successful investing do not. If you have questions about how this environment impacts your portfolio, don't hesitate to reach out. I'm here to help you navigate through times like this with clarity and confidence. I'm Professor Jacob Gold, and thank you for watching.